All right, good morning, everyone, and thank you for joining us on day 2 of Cherry Bekaert's 2021 Virtual Real Estate and Construction Conference. My name is Mlk Gateway. I'm a tax partner with Cherry Bekaert and also the leader of the Cherry Bekaert Real Estate and Construction Industry Practice. We're excited to have those of you that joined us yesterday back again for day 2, and for those of you just joining us for the first time today, welcome. Our virtual conference features 4 presentations on a variety of hot topics, recent developments, and proposed updates tailored to the real estate and construction industry. And we are excited about the lineup we have planned for this week, and we'll be offering up to 1 hour of CPE per session. We hope everyone will be able to join us for all the remaining sessions, both today, tomorrow, and Friday. Here's some quick housekeeping items before we get started. If you're online to receive CPE credits, you must answer at least 3 polling questions and attend for the full 50 minutes. A short survey will be posted at the conclusion of the webinar. That's for all attendees, just to give us some feedback on how we're doing. CPE certificates will be issued via email within 10 days. And if after 10 days you've not received it, please email cbhlearning@cbh.com. A recorded version of this webinar will be available in about 1 week. It will be sent via email and posted to our website. If you have any questions during the webinar, please type them in the Q&A window located on your control panel. And with that, I'll turn it over to Rick Snyder and our panelists who will discuss hurdles they've encountered when structuring Opportunity Zone deals and how to overcome them, along with best practices for sourcing and developing projects using OZ Capital as a key source of funds. With that, Rick.
Thank you, Mark. And again, welcome everybody to our webinar today on Opportunity Zone deal panels, lessons learned and best practices. Again, my name's Rick Schneider. I'm a partner with Cherry Bekaert in our Washington, D.C. practice. I'm a member of our real estate industry group, and also I lead our Opportunity Zone task force. So today, we have a great panel of folks who come today to talk to you all about lessons learned and best practices as it relates to operating Opportunity Zone funds, the fundraising aspects, the development aspects. So we've got a lot of good stuff to share with you today. Our first panelist is James Brunger. James is Executive Vice President of National Sales for Capital Square. He's active in the management of Capital Square as a member of the Development, Acquisition, and Executive Management Committees. He spearheaded the Opportunity Zone program at Capital Square with their internal development company. The next panelist we have is Brian Burke. Brian is Executive VP of Development for the Mlk Group. The Mlk Group is a 100% minority-owned certified business enterprise in Washington, D.C., but also has offices in Massachusetts. Mlk Group is a company that approaches urban neighborhood transformation and investment centered on residential and commercial development, residential sales, and commercial brokerage. Brian's role is to manage the team that executes the entire development process from acquisition and financing to design and construction. And Brian's team has recently completed 2 OZ projects and is beginning construction on a 3rd, which I think he'll share with us in his comments. Our next panelist is Branson Lee. Branson is a partner in the Atlanta office of the law firm of Alston and Burke. His practice focuses on real estate joint ventures and fund formation, including Opportunity Zone funds and development projects. Branson represents developers, fund managers, and investors in all aspects of Opportunity Zone matters. And then our final panelist is our very own Kat Baisley. Kat is a partner in our Atlanta office for Cherry Bekaert. She is also a member of the real estate industry team and is on the Opportunity Zone task force as well. So her focus is with real estate developers, funds, and investors in real estate, and assist them in all aspects of Opportunity Zone projects. So before we get to the panelists' opening comments, let's go to our first poll of the day, and we will have a few. So if you're interested in an Opportunity Zone project, but haven't started one yet, why not? So let us know, is it challenge in raising capital, challenge in finding a good deal? You have a project, but not sure where to start, all the above or none of the above. So let us know. We'll give you another, say, 40 seconds or so to respond. And while we wait, again, interestingly, we're in the 4th year of the legislation, which was enacted back in 2017. And we've seen a lot of developments and matters occurring over the last 4 years, not to mention of which we have the proposed regulations that came out. The final initial set of regulations came out in the end of 2019. So we've only been really working with a lot of guidance for the last 2 years. And then of course we have the pandemic, and the pandemic included also additional legislation as well as relief provisions that were announced by the IRS for those who are investing as well as those who are managing projects in opportunity zones. So let's go to the share results here. So it looks like we've got the biggest challenge being, well, besides none of the above, our biggest challenge is finding a good deal. Well, we'll probably share some insights as far as that goes on today's panel, but we'll go ahead and proceed with our panelists providing their opening comments. So James, I'll turn it over to you.
Good morning. Thank you, everybody. Thank you, Rick. Thank you, Cherry Bekaert. Really appreciate the opportunity to be here. I know most everybody's here for CPE, but hopefully you learned something as well. You know, we can make it a little bit more interesting. It is amazing. We are in the 4th year of legislation. I feel like this is the year where people are finally realizing what opportunity zones are, what they can do. And then specifically on our side, you know, we're getting developments fully completed. People are starting to realize that it actually does translate into, in our case, housing solutions in undercapitalized communities. So thrilled to be here. I am Executive Vice President. I helped create our program here at Capital Square. Very fortunate. We are a $3.5 billion assets under management, tax advantage real estate sponsor. So we're very familiar with a variety of just different tax advantages associated in real estate. For us, opportunity zones were a natural progression of our business. They were part of the Tax and Jobs Cut Act of 2017, real high level, just going back to the start. As part of the legislation, it was a bipartisan legislation. The 2 leads on this were Senator Tim Scott, a Republican, and Senator Cory Booker, a Democrat. And then it's got broad support across the aisle and continues to have broad support across the aisle. And the real focus of the reason why opportunity zones were created was to provide capital to undercapitalized communities. Pretty basic, but one of the big things too was to make sure that the legislation itself didn't have a lot of impediments. It wasn't heavy on regulation. It was more kind of self-certification, easy to implement, and the idea being that would also get capital into the market in these undercapitalized communities relatively quickly. And so far, it's been pretty successful. Rick, if you can go to the next slide. Just as a quick, idea and a review of what's in it for investors from a tax side. There's 3 great benefits associated with the program and opportunity zone investing. Number 1 is initial tax deferral. If you invest a capital gain within 180 days of the date of realization, some nuance to that, especially on pass-through entities, partnership entities. Kat may touch on that later, or Cherry Bekaert could certainly help you in more detail. But if you invest within 180 days, first and foremost, you receive tax deferral on your capital gain. Secondly, there is a partial elimination. That partial elimination, if you've invested for at least 5 years by the end of tax year 2026, you receive a 10% reduction of your capital gains tax. One thing to note, obviously 5 years to the end of 2026 means you have to invest by the end of 2021 to have at least held it for 5 years. So we're on a countdown, everybody. If your investors or if your clients are interested in getting that 10% reduction bonus, this is the time to take a look at getting invested, and if there are any gains harvested. Taxes are due on April 15th, 2027. The tax will be at the tax rate of 2026, so the capital gains rate then. And then the biggest and by far, so initial tax deferral, partial elimination, the biggest and most identifiable long-term benefit is complete elimination of capital gain on your investment if the investment is held for at least a period of 10 years. Again, some nuance to that, but the reality is these are long-term investments, long-term capital commitments to undercapitalized communities that provide massive benefits, including the elimination of capital gain beyond that 10-year hold. Rick, if you can go to the next slide. Just real quick, what can you invest? I said 180 days capital gain. What you're really looking at capital gain is either short or long-term gain, and reinvesting those proceeds into a qualified opportunity zone within 180 days. One thing to note, we see gains coming from business sales, real estate, art, a lot of crypto this year, which is kind of odd just because it has done so well, but we have a lot of people with long gains and short gains in Bitcoin. Really anything that kicks off a capital gain, you can invest those proceeds and receive these benefits. And again, just to review a little bit of what we're doing on that side, and we have a couple others as well. Rick, if you can go to the next slide. What can you invest in? In our case, we do single asset opportunity zone development projects. We do housing solutions, primarily multifamily. Our project that we have open today will break ground next year as a 20-story tower in downtown Raleigh. Picture right behind me as well. Oh, other side right behind me. That's the rendering of the building right in the heart of downtown, but in a undercapitalized side of downtown, the traditional warehouse district. So this is going to add a really skyline changing benefit to a side of downtown Raleigh that, number one, doesn't have a lot of housing solutions, but number two, really has been kind of overlooked, if you will. But that's why it was designated an opportunity zone, even urban locations such as this. If you can go to the next slide. So just to give you a scale, what are opportunity zones? There are thousands of opportunity zones all around the country. There are a number of resources to be able to show, highlight the map of opportunity zones. They were designated by state representatives. They are the bottom 25% of 2010 census data as far as economic activity. So in this area, in downtown Raleigh, this area in 2010 was in the bottom 25% of economic activity. Thus got designated by state representatives as opportunity zone to be able to get these benefits and look at private capital moving into this area. For us, obviously, this is a great location, but you can kind of see we're going to build a tower right next to where there really is nothing else right now. So that's a high level. That's a high level on who we are. It's a high level of what we're working on as well. I'll turn it back over to you, Rick, and really, again, appreciate the time and the opportunity to be here.
Brian, you want to go ahead and give us your
thing. Thanks, Rick. Good morning. My name is Brian Burke. I'm Executive Vice President of Development with the Mlk Group. The Mlk Group is an integrated real estate services company that focuses on emerging urban neighborhoods, predominantly in Washington, D.C., where we were started in 2004, but we also work in Massachusetts, mainly in Worcester, Massachusetts. Our company, I focus on development, but our company also has a large sales and brokerage business, sister company that we work closely with. If you can go to the next slide, Rick. Yeah, actually, let's keep going to the next slide. I'm going to talk about 3 recent opportunity zone deals that we've worked on. Our company was, I guess, lucky enough to find ourselves working in neighborhoods, deeply working in neighborhoods that ended up being designated as opportunity zones through the legislation and through the choices of the individual municipalities and states. So we didn't necessarily go out looking for opportunity zone deals. They sort of found us a little bit more, which was great for us. It didn't really change our approach to looking for deals because we had already been working in these neighborhoods, but it did change our approach to finding equity. for the project. So the first project I'll talk about is the Mlk Gateway Project. This was a partnership with the District of Columbia where they disposed of some vacant underutilized land. We constructed a 34,000 square foot mixed use office and retail building right in the heart of historic Anacostia, which is, for those of you that know DC, a very underinvested neighborhood within the district, but yet very close to some of the very fast growing neighborhoods in the district. So for us, with this being an opportunity zone, it allowed us to really go out and find some capital that was interested in going into emerging neighborhoods and putting their money into projects that not only make a return but also have an impact. So that was really the type of investor that we've been looking for all along. Sorry, Rick, can you go back to that one for 1 second? Thank you.
Yeah.
This deal was paired with New Market tax credits, which I think we've heard that this was one of the first New Market tax credit OZ paired deals to get done after the initiation of the OZ program. So we were early on in figuring out how to make those two programs work together. What we really found out was that they work well side by side. They don't work super well completely combined together, but they do pair well in side by side. So really part of our project is funded with New Market tax credits and another part is funded by equity, which does end up working pretty well. This deal closed in December of 2019 and it just finished construction last month with the office tenant and two of the retail tenants taking occupancy. This deal ended up with two OZ fund investors, one of which was a friends and family fund and another was a high net worth individual. All right, let's go to the next slide. This next deal is a residential project in Worcester, Massachusetts, former YWCA that was renovated into a 24-unit apartment building. This project was going to be highly reliant on historic tax credits, and we've been working on generating state historic tax credits and federal tax credits up there for quite a while. And then once most of Worcester was designated as an opportunity zone, it allowed us to then pivot our equity strategy to use two different OZ funds, both friends and family funds, to provide the equity into the deal. To bring this all together. This deal closed in April of 2020, just after the pandemic really got going. So we were really happy to be able to get that closed in a challenging market. And this also just finished construction last month with tenants moving in at the beginning of November. And then lastly, I'll talk about the Mlk Gateway Phase 2 project, the second phase of the first project that I spoke about. This is a larger project, which is right across the street from the first phase. The building is about 100,000 square feet with about 70,000 square feet of rentable space plus 2 levels of underground garage. This deal is anchored by a government agency that will be leasing the majority of the office space, the Department of Housing and Community Development, and then we'll be pairing that with ground floor retail, some community serving retailers, restaurants, and a small brokerage office of our sales business. This project has similar financing to the first phase in that we're using New Market equity. The difference here is that we've done much more of a staged financing of this in that we've been raising opportunity zone equity for quite a while to acquire the land and to start some of the pre-development activities. Then we closed on a senior loan in August, and now we're actually closing on the New Markets piece of this in later this month. So multi-stage financing to this. This one also being a little bit larger deal. We ended up going out and raising some institutional opportunity zone equity from a fund out of Tennessee. In total, between the sponsor funds, some friends and family funds, and this institution, we have 6 different opportunity zone funds that are invested in our QOZB here. So a pretty layered capital stack on this project. This project is just kicking off construction now and will deliver in early 2023. I think that's it for me, Rick. Thank you.
All right, Branson.
Yeah, thanks, Rick. Good morning, everyone. I'm Branson Lee, partner at Alston & Bird. We are a full service law firm headquartered in Atlanta with offices sort of all over the country and in Europe. Rick, if you want to go to the next slide, I can get through this slide pretty quickly. It's my only one. Always like to kind of set up the structure here. This is pretty much what every real estate development opportunity zone structure looks like, and I'll throw around these terms QOF or QOF and QOZB or QOZB kind of as I'm talking. So as most people on this call know probably already, it's, you always have the taxpayer looking for the tax benefits who invest in the QOF, and the QOF turns around and invests in the QOZB, which owns the property and the project. So there can be various disregarded entities in between there, but that's the sort of basic structure. So now that we're through that, so Alston and Bird, what we do is represent, or at least what our OZ practice does is represent fund managers, developers, and investors in opportunity zone matters. We've also done some representation in front of the IRS and tax controversy type matters where we had clients come to us after sort of having a misstep in the OZ rules. So one of the first things that I always counsel my clients, whether it's a fund manager or a developer that's responsible for ensuring QOZB compliance, is always have the CPAs or the lawyers involved at the front end to make sure that the structuring is right, because it's so easy to mess up, and lots of times it's just a slight tweak to the transaction structure is all you need to sort of get it right and be safe. So to go back to sort of what Alston does, we have represented numerous sort of commingled fundraisers that are structured as QOFs. Those funds go out and raise, several $100 million of equity, and then they typically go out and joint venture with third-party developers who have formed QOZBs. And so our fund clients or fund manager clients they're either 90% plus of the equity in a QOZB or something closer to 50-50, or they are a minority investor in the QOZB. So each of those scenarios presents sort of its own idiosyncrasies from the standpoint of negotiating the QOF's rights in the QOZB LLC agreement. We also represent the developers who are taking in capital from these QOFs, and we also represent developers and investors who sort of set up captive type QOFs with their own money, investing their own gains in their own projects, and kind of doing everything in-house. So I guess to sort of wrap it up, I mean, we've sort of seen everything across the spectrum and lots of interesting structures that hopefully we'll have time to get into a little bit later in the presentation. Rick.
Thank you, Branson. Kat?
Good morning, everyone. I will keep this brief so we can get into the nitty-gritty of our presentation. Like Branson, I am a partner that works with real estate developers, fund managers, and investors in the OZ space. We help with structuring, with testing, which is so important in the OZ world, and tax return and compliance. I'm a partner in our Atlanta office. I am, as Rick mentioned, a member of the real estate and construction executive team and the OZ task force. Let's go ahead and get started because I know we have a lot of questions and meat that we want to get to rather than just hearing the tax dork talk.
Thanks, Kat. So before we jump into our questions, we have one more polling question. So have you explored an opportunity zone in 2021? Yes or no? Again, these are just to try and sort of level set our panel with where you all are from an audience perspective. So right now, looks like the leading response, we've still got about 20 seconds left. I'm sorry, about 30 seconds left on this, but looks like we're basically predominantly no one's explored, but we still have 35% that said, yes, they have looked at opportunity zones in 2021. Maddie, let's go ahead and close this one out. We can move into our questions. And with that, I'm going to stop sharing my screen and really get focused on our questions. So the first question to our panel is really with regard to investor side fundraising. So, you know, we've heard a little bit in terms of the history. We've obviously seen the pandemic have take its effect on businesses as well as with regard to opportunity zone developments. But from your perspective, what was your initial fundraising approach? And again, the rule's been around for 4 years. What was your initial approach to attract investors, and how has, and you know, if it has changed now, how so has it changed? So I'm going to target that to James first, and then to Brian, and then Branson and Kat, if you want to jump in.
Sure. I forgot about that pandemic thing. You're right. So our initial approach, we started with a bunch of road shows. We went out to show the world what an opportunity zone was, and did events around DC, Virginia. We're located in Richmond, Virginia, and really got some interest on our first projects, which are in the heart of Richmond, Virginia. But it was slow going. Nobody had any idea what an OZ was. Now, where we've come, we do a lot of webinars. We participate in a lot. Now the industry has gotten a little bit bigger. There's a lot more outlets for us to be able to get the message across about what we've got going on. Our primary function, we've gone back to our primary sources of distribution for capital raising, which in the 1031 space, which is predominant on our business, that's through broker dealers, registered investment advisors, family offices, and small institutions. They've now started to take part just because they've gotten more comfortable with what an opportunity zone is, the benefits. And then, you know, frankly, I would say, Rick, the other thing too is that, you know, the potential for tax changes this year, capital gains rate, everything that's gone on through legislation for the infrastructure bill, the Build Back Better bill, you know, that's gotten people thinking more about how to defer, how to eliminate, how to reduce taxes. So that has been a big catalyst where I think this year we're going to have a record year in our opportunity zone fundraising. And I think a lot of those confluences, a little bit of relief from the pandemic, a little bit more acceptance, more avenues, channels, things like this, where people are having, you know, meaningful discussions about opportunity zones. That's really helped us out and gotten a lot more traction. I see it continuing all the way through, you know, although there's that additional 10% reduction benefit investing this year. Opportunity zones are going to be here for a while. There's potential talk of extending some of the investment horizons as well, which I bet happens since there's, you know, it's been successful. But, you know, our approach has changed slightly, went way more virtual during the pandemic, but now it's really, you know, started to take a life of its own just because people are starting to know more about it and feel more comfortable investing in opportunity zones.
Thank you. Brian?
Sure. Yeah, I think I guess for us at the beginning of the OZ, when the OZ world was created, we were really gung ho on it, and given, like I said earlier, we work in neighborhoods that were largely designated as opportunity zones. We initially planned to raise a large commingled OZ fund, $100 million OZ fund that we would use to deploy into our projects and other projects. As we sort of started working through that, we quickly realized there were a lot of complexities to that with timing and with having commingled investments in various deals. And so we ended up pivoting from that and focusing much more on a deal by deal investment strategy, capital raising strategy. Coupled with that, you know, we found that between internal capital gains that our company had generated plus friends and family gains of either related parties or other folks we knew, we actually had access to a lot of gains and a lot of people that wanted to put money into funds. And some of our early deals were largely funded with those internal gains and the related party investors. As we got into the third deal, as I mentioned, we pivoted a little bit and went out and did more of an institutional opportunity zone raised, going out to opportunity zone funds to to get interest in our deals and to put in a portion of the capital stack into those projects. So I guess it's kind of gone from a very grandiose strategy down to a more targeted strategy, and now expanding back out a little bit to a broader institutional investor approach. But in all cases, it seems that we're finding that a deal by deal opportunity zone fund approach is the preferred structure.
Yeah, Brian, it's interesting you mentioned that, because I remember well the early days of the OZ program and all of the painful structures that we sort of went through involving REITs, where you wouldn't otherwise need a REIT, to try to get around the issues with a commingled fund structure. Fortunately, now after the final regs came out, those structures are not nearly as hard to make happen. The capital raising is still an issue, but it's much easier to make those commingled fund structures work these days.
Yeah, and we have started to look into that, and we may start to use some commingled funds in the future. But yeah, no, it is great that they clarified that.
One thing that I've seen that has changed a bit just in the past year is the increase in opportunity zone investments due to the attention that's been placed on 1031 exchanges and how that might, for a while, 1031s were on, tax deferred exchanges were on the chopping block this year. That has raised awareness and interest in opportunity zone investments in my world.
Terrific, thank you. So the next question I have is really back to James and Brian. Again, Kat and Branson, please jump in. Have you seen OZ investors willing to accept below market returns based on the tax benefits they will receive program? And maybe Brian, why don't you start it off, then we'll go to James.
Sure, I'll start. This was my question because frankly, I'm very curious. We have not seen it. I think in the early days, we had hoped that given the benefits to the investor, the tax after tax benefits, that we would see investors be willing to come in at a either lower pref or lower targeted IRR. We haven't really seen that. We've seen investors, I think, be interested in coming into deals into neighborhoods that they might not have otherwise been willing to come into. But we haven't personally seen investors be willing to take sort of more social impact level returns based on the tax benefits.
Yeah, same thing. Good real estate first, good real estate investments first, sound investments first. Capital gain elimination is great, but you got to have a capital gain to be able to eliminate. And, I hear that constantly. So, we focus on great real estate, make sure that they make a lot of sense from a real estate perspective, but absolutely. If it's not a good opportunity for investment return, it's not attracting the tax benefit and or the social impact of capitalizing undercapitalized communities is not the leading edge in 90% of the cases. We do get a little bit more, and these are people who are also asking a lot of ESG questions. We do get a little bit more on very small margin about social impact, measurement of social impact. But I would say it's not to what we expected at the beginning. It really has just been, show us great real estate first, in our case, real estate, but show us great opportunity first, and then we'll take a look at what some of the ancillary benefits are and then kind of measure beyond that as well.
Okay. Branson or Kat, any other comments? No. All right. Kat mentioned about 1031 exchanges. Again, it was on the chopping block in terms of proposed legislation earlier on in the year. And have you seen, again, they're kind of the main alternative to deferring gain on the sale of real estate in particular. But, other than an OZ investment election, but have you seen movement by investors away from 1031s to OZ investment deals, particularly maybe this year, and any insights with regard to prior years? And again, I'm going to start with Brian and then James, and then I'll open it up to Branson and Kat.
Yeah, one thing we have seen personally, we had deal that we were planning to 1031, and we weren't finding great options to 1031 into. And so instead of trying to force a deal that may not have been really the right investment for us just to meet our 1031 timeframes, having OZ as a backup was a nice alternative. The tax benefits are obviously somewhat different, but they both are a way to defer and reduce capital gains. And so for us, having OZ as a backup place to put those capital gains was a nice alternative for us to use.
Yeah, we primary business for Capital Square is 1031 syndicated 1031 programs called Delaware Statutory Trust. That business has grown about 220% this year. We do see blown exchanges. So people who had an intention to 1031, they blew the exchange, couldn't find good real estate. It has been kind of, we wanted 1031, but we couldn't find a good real estate that made sense for us. We like these development opportunities better. They happen to be opportunity zones. Great. The majority of our investments in OZs are non-real estate capital gain transactions. And that is obviously with bias simply because we are so involved in the 1031 space. But 1031s just in general are going to have a record year. I don't think OZs are taking anything away from 1031. It seems like, that transaction volume across the entire industry, across the board, is going to stay very, very high. Really, I bet, if we look back on this, especially this year being a record OZ funding year, I'd be surprised if the vast majority is non-real estate capital gain transactions.
All right. Let's go to the capital stack a little bit. Brian had mentioned earlier on in terms of being able to combine new markets tax credits, some historic tax credits as sources of capital in terms of their equities, and capital stack. And I think, James mentioned in terms of, having some commingled funds, which would be more traditional, as well as OZ equity funding that are coming together. So again, I'll start with Brian and then go to James. And then I really want to hear from Branson and Kat as far as this goes. What's been your experience in combining these elements in the capital stack? And did you face any unique challenges, and how did you go about or addressing them?
Sure, I'll touch on this again quickly. We found that we have paired OZs with both historics and new markets and some other grant and subsidy programs. In general, the OZ funds pair really nicely with historic tax credits. We haven't really seen any issues there. On the new market side, we originally, for those that are familiar with the new market structure, there are sometimes opportunities to leverage your equity through the new market structure. If you have OZ equity, you can't do that, and so that's really the challenge that we saw. And so the net benefit, or the net result, I guess, would be that you might be able to leverage less dollars through the new market structure, but you can still keep your equity sort of alongside your new market structure if it's opportunity zone equity, and still complete the deal without any real complications that we've seen. So it's a small change to how much leverage you could get in the deal, but overall they still work pretty well together. Okay,
thank you.
I'll defer to Branson. We've reviewed it a couple of times. We've never set up the structure or capital structure where we've had commingled on that type of with tax credit. We reviewed a couple of them, but it just didn't make any sense, and we really didn't even pursue those deals. So maybe Branson has more intel.
Yeah, I would echo what Brian says. I mean, the ones that I've done where there have been tax credits combined with OZ money, it's really a side-by-side thing. Your OZ investors are not the same investors who are after the tax credits. So you've got a tax equity vehicle, and then you've got an OZ, a QOF, and they come together at the JV level down at the bottom. So more of a side-by-side thing.
Kat, any other comments?
One thing that I have seen with a couple of my clients is, some great local government support for their projects. One project in Arizona, the city donated a land lease to the project to help kick it off. a project here in Atlanta. Unfortunately, they purchased a hotel February 22nd of 2020. So possibly the worst timing that you could have in downtown Atlanta, but the city worked with them and actually helped house homeless people during the pandemic. So there has been a lot more local support for these projects than I have historically seen. And it's translated into adding a layer to the capital stack.
All right, thank you. So getting into a little more of the deal flow side of the deal side, how has everyone seen deal flow go this past year, now that we're again in the year 4 of the program, and maybe comparing it to earlier years? Because I envisioned and I've seen, I know with clients where it was, early on, it was new, it was a program a lot of people were interested in. But I think, the pandemic really did slow it down a bit. So again, want to get your guys' experience. And let's go ahead and start. Actually, Branson, let's hear from your perspective with your clients, and then we'll come back to I'll have Kat go next, and then James and Brian last.
Sure. Yeah. So while the pandemic did kill some deals for me, it didn't kill any OZ deals I had going on. I think that the deal flow has really picked up this year. And the deals have gotten a lot more. It's such a smoother process now than it was to begin with, because people know what they're doing. There's a roadmap for almost everything now. Particularly the commingled funds, raising capital and deploying that capital, that feels like a much smoother process now, and we're seeing a lot more of that. And just to jump back to the DST point, we're also seeing a lot of that. And so maybe it's just the case that a lot of people have a lot of gains this year, and they're looking to find a way to defer those. So deal flow in general is just, I know tons of lawyers out there, including most of us at Alston & Bird, are just absolutely drowning right now in work. So it's a great thing, but so yeah, lots of deals.
I would echo what Branson said. A lot of deals, and I think people are having to step back and reevaluate what they're doing in the OZ space. Several of my clients have gotten fantastic offers on land that they purchased for the OZ fund and that they had planned to develop, but then the offer was so great, they've turned around and sold that land and are looking for new investments. So it's really been a unique landscape for real estate projects.
Good. James or Brian, any other quick comments?
As deal flows increase, it's got harder to find good deals.
Okay.
Our land bank with the building behind me, we bought the land 2018. We couldn't afford it in 2021. So, obviously with interest and high capital flow, high capital gain, and everybody putting together great single asset or commingled funds, it's tougher and tougher to find the really good opportunities inside of OZs, just simply because basis has gone up significantly with deal flow.
Brian?
We're pretty much just financing our deals that we have in our pipeline, so we're not seeing overall market deal flow as much.
Okay. All right. So one of the other things too, in terms of deploying capital, again, the OZ rules have various timelines that one has to contend with. There's the 31-month safe harbor for working capital, 30 months with regard to substantial improvement of assets. You also have on top of that, local zoning, permitting processes and timing. And of course, the pandemic has created now some supply chain issues. So what's been your experience in addressing all of these challenges, along with the interaction with the timing requirements of the Opportunity Zone rules? And Brian, I'll start with you, and then Branson, I'd like to get your perspective from the clients that you've worked with.
I guess in 2 of the deals that we've completed, we didn't run into any issues with completion in that timeline. The deal that we still have outstanding, I think that, depending on how things go with supply chain issues and other delays, we might get close. Hopefully we will not have any issues, but it's something that we're monitoring.
Yeah, so right now we're having sort of very, very late stage discussions with several clients who are looking to get the gains into their gains into QAFs before the end of 2021. And I know we got a question about this, about the significance of the end of year in 2021. So one of the three benefits to the Opportunity Zone program is the basis step up. And there's a 10% basis step up if you hold your QAF investment for 5 years, but that only applies if you hold it for 5 years prior to December 31, 2026. So as of the end of this year, it won't be possible to hold for 5 years prior to December 31, 2026. So that 10% basis bump is off the table. So if you're going to invest now or early next year, much better to do it now than next year. So we're dealing with some of that. As far as the timing rules go, just in general, I mean, it's an incredible challenge for fund managers who are very successful in raising capital to then deploy that capital quickly enough, right? And it's hugely important if you go out and raise $300 million in several months, which our clients are not having problems doing, you then have to make sure that you have a healthy enough pipeline of deals to absorb that capital in the time that it's required to be absorbed in. So, for example, now we'll have a fund with its final closing December 31, and they've already deployed a substantial amount of their capital, but they'll have another 250 million to go, and basically all of that needs to be put into QASBs before mid-year next year. So that's a lot of that. Hopefully you get $100 million JV project in there somewhere, but if you're doing it in $30 million tranches, that's a lot of JVs. So definitely important to have a healthy pipeline.
Great. Kat?
I would agree. I think what I have seen a lot of is that the capital wasn't being deployed timely, and the pandemic relaxation of the penalties being assessed for capital not being deployed has really saved a lot of my clients. I mean, so for those of you that are fund managers and kind of took a little bit of a pass on worrying about the timing and the deployment of your capital, you need to look at it now. We had some safety measures in place that helped us, and it's going to be a huge push to make sure that all of that testing is done and people are compliant.
Yeah. So speaking of fund managers, let me turn now to, again, what issues should fund sponsors be considering when they raise third-party capital from an OZ fund? And again, I'm going to start with Branson on this one.
Yeah, so I think most importantly, as I already mentioned, it's super important to have a very healthy pipeline to make sure that you're not going to raise your capital and then have to turn around and give it back to your investors and say, sorry, you're not going to get the tax benefits we thought you were going to get because we couldn't find enough investments. So, it's almost as if you need, before you take in the capital, you need to have a really good idea of where it's going to go. And then when once you have that capital sort of at the JV level, you want to be really careful to, and I'll echo what I think I said earlier, bring in the CPAs up front, bring in the OZ counsel up front, because you want to make sure you structure that JV in the right way. I mean, a lot of times we'll be served up documents where there's a disguised sale of partnership issue problem. There's a they want to refi member loans, and those member loans may not be treated as debt for tax purposes. All sorts of things that could just basically completely bust your OZ status on those types of deals. And those are critically important issues. So yeah, I would just say healthy pipeline, and then make sure that you're appropriately sort of diligencing and structuring all of your investments into QASBs.
Yep. Thank you. Kat, any to add to that?
I completely agree. I mean, I've seen deals where, somebody thought they had set up a QOZB appropriately and they hadn't. So it was really the QAF level. And, that you can blow all of your testing, instantly. You think you're deploying 70% of your capital into assets, and really you're a QAF. So it's 90%. So that it's something that people really, really need to look at.
Yeah. James or Brian, anything to add?
We don't even raise capital until our deals are fully entitled and shovel ready, and we have a very strict timeline. So timelines are not an issue. We do have a lot of JV partners coming at us where funds are trying to deploy capital, term sheets being traded, take down entire deals. It's interesting. I hear you, Branson. I feel like there's more and more people who are getting ahead of the capital raise and not on the deal side. So we're very, very cautious. The last thing, we're in the business of tax advantage real estate investing. We're not in the business of creating tax problems. So we can't let the deal blow up the issue.
Yeah, just echoing what I said earlier, we decided not to raise capital in advance of having pipeline to deploy it into. So now we're just raising for individual deals when they need the capital.
So one last question, and then we're going to go to a poll. I'd like to get at people's perspective in terms of how have they seen the states react to the OZ legislation, twofold in terms of, jumping on the bandwagon in terms of adopting the rules, as well as, helping to, make it easier to do deals in their jurisdictions. And I know some places have actually put in expedited permitting processes in order to contend with the tight timelines that the OZ rules required. So again, Kat, why don't we start with you in terms of what your clients have seen and what you've seen from a state perspective, and then we'll go through with the other folks.
Okay. I briefly touched on this earlier. Both the city of Atlanta and some of the localities in Arizona have been very friendly to OZ deals, which is delightful. And I haven't seen much in some of the other states that we've interacted in where the local governments haven't been as involved in the projects, but the city of Atlanta has worked very closely and very hard at promoting the OZ projects.
Brian, from the standpoint of DC?
Yeah, so recently DC has decided that they will also give OZ benefits at the state level, or at the district level in our case. What we saw though is that they are much more stringent around what they will allow to qualify as an OZ deal, and there has to be a number of hurdles you have to cover that get to more impact measures and reporting measures. And so while at the federal level, if you're in the zone, you're in the zone. Within DC, you can get the benefits, but there are a number of steps that you have to get there. Some applications that you have to go through to be qualified, first of all, and then some ongoing reporting around the community benefits that are generated through the OZ investment.
Yeah. Branson, what have you seen with your clients?
To be completely honest, most of my clients are not making any sort of decisions based on state and local incentives. It's sort of they find the deal, they want the federal level to work, and we make sure it does. And then the state and local incentives are sort of, if it works, it works. And we're all over the place. So I typically defer to the people like Kat who probably have a little more expertise in that area when those types of issues come up.
James, any comments as far as what you're seeing from a state and local perspective?
No, the states that are non-conforming, it seems like the capital raise has been a lot less. So California, Massachusetts, North Carolina. But most people realize the federal benefits are much larger. As far as municipalities getting projects off the ground, we've reached really no resistance at the same time, except for Virginia, where the previous administration governor's office set up a organization called Opportunity VA to match opportunities and investors and a variety of other things. Really haven't seen a lot of state support as far as kind of, promoting the overall idea about opportunity zones.
Yeah. And I know some states have done similar things that Virginia did in terms of putting together an opportunities czar, help attract money into the projects that were in the zones in their jurisdictions. We're going to go to another polling question. Number 4, Maddie, if we can pull that up. So this is, sorry, did I miss one? I did miss one. My
Conversation was just flowing.
Yeah, it was. So this is polling question number 3, and I apologize, we should have run this a little earlier. 10% reduction in the deferred gain benefit doesn't extend. Will opportunity zone investments be impacted? What do you think? Increase, decrease, no change, or unsure? We're seeing predominantly, we're seeing a decrease as the response by everybody. So, yeah, one would expect that there might be a tail off, but we'll see. We'll have to see if legislation actually gets enacted to extend the program further. So let's go ahead and shut that down and go actually to polling question number 4, and then we're going to open it up to the audience. So polling question number 4, given the interest in information impact reporting regarding opportunity zone projects, including the release of the recent GAO report mentioned. Well, so there was a GAO report that was released about 2-3 weeks ago based on IRS data through 2019. The biggest thing that the GAO mentioned in their report was that there isn't a lot of data to measure impact of the overall program in achieving its objectives in terms of spurring economic, activity within the different zones that have been designated. So what do you feel is going to happen in the future as far as information reporting, more information, less information, not sure. So predominant folks on this one are responding with more reporting with lower the investment odds in the future. So we'll see what happens as far as that goes. With that, I'm going to see if we have any Q&A in the queue, if I can figure out where to find that again.
Yeah, we do. I can go ahead and kick some of those off.
Oh,
One question is, any thoughts on the amount of OZ projects that are focused on raw land versus new build versus rehab projects? Anybody have? I have a wide mixture.
Same.
I mean, I would
And
say
it's
it's probably 50-50.
Right, and the new builds aren't, it's not necessarily always on raw land. It's sometimes acquiring a developed parcel, demolishing what's there, and then building ground up.
Doubling the basis is pretty easy in any project. So, yeah, I would say, you'll continue to see kind of a mixture all the way across. Those projects that are redevelopment, so value add, I think those are pretty attractive to a lot of investors simply because there's generally an income component or cash flow that's a little bit more measurable right at the start. I don't know if that's, a good or a bad thing, but at least on the capital side, it seems like redevelopment value add is pretty attractive as long as the project doubles the basis, which again isn't that hard to do in today's world.
Yeah, I'll agree with that. With their construction costs are doubling the basis is unfortunately much easier than we would like it to be. So yeah, we've seen a mix of deals. Some are more raw land, but several are rehabs, and yeah, we've not seen an issue with getting to a doubling of the basis in those deals. If it's a very light value add deal, it may not work, but ours are mostly full gut rehabs, which qualify for these.
Right. One of the questions is with regard to selling property before the end of the 10-year hold for the capital gain elimination, say in year 5, and the ability to roll over that gain into another deal and still only count the remaining of the 10 years left in order to qualify for the tax-free treatment at the end. And I think rules are pretty clear that when you do have a transaction like that, the clock starts over. So you can roll it over into a new investment, but if you're an investor in the fund, you may have a new clock in terms of your investment within the fund. That is a matter, you can't roll the gain. The gain is going to come out, but you can continue to have your investment as an investor in a fund qualify if you have your own 10-year hold period. So not sure in terms of the direction of that question, but again, within the fund, the investors are still protected as far as they're holding their 10-year investment in the fund, but within the fund itself, selling an asset, gain on that sale is still going to come out to the partners. Branson, Kat, any other comments there?
Yeah, I mean, it obviously depends on whether you've got a corp or a partnership as your quaff. Most are partnerships. So yeah, that will not shield you from the gain on that sale.
Right.
And then from there, it depends on whether the quaff reinvests the proceeds or distributes the cash out. So yeah, you have a year to reinvest for the quaff to reinvest the proceeds, and that's typically what people are doing.
Great. Well, and thank you everybody for your contributions and insights and sharing with us today. I want to thank all my panelists. Mark, I'll turn it over to you.
All right. Thanks, Rick. So that concludes our second session of our conference, and thank you again for attending. If you have any additional questions regarding today's topic, please reach out. Feel free to reach out to any of the panelists or myself at any time. We value your feedback and ask you to take part in a short survey, which will appear when you leave the session, just to give us some feedback on today's session. And our next webinar is tomorrow morning at 10, which will be year-end tax planning for real estate and construction. And hopefully we will see you again then. Thank you, everybody.